The financial effects of a natural disaster. Larger disasters have wreaked tens of billions of dollars in damage. Natural disasters, from hurricanes and earthquakes to droughts and floods, have the power not only to upend the lives of local residents, but also to create a substantial expense for governments, businesses, and individual residents. Larger disasters, such as Hurricanes Katrina and Harvey, have left tens of billions of dollars in damage in their wake. Those costs are borne most acutely by individual property owners in the area affected. However, the public also picks up a large part of the tab through local and federal disaster funds, as well as homeowner insurance policies that pay for much of the rebuilding afterward. The greater frequency of large-scale natural disasters in recent decades means that the financial impact is becoming costlier than at any time in recent history. The unforeseen events of 2020 and 2021, meanwhile, are proving to be costlier than any of the natural disasters that the United States has faced, not to mention their impact on the global economy. Then, President Donald Trump signed a $2 trillion coronavirus emergency stimulus package called the CARES Act into law on March 27, 2020. It was followed by a second round of stimulus totaling $900 billion, signed into law in December 2020. The American Rescue Plan Act of 2021, a $1.09 trillion coronavirus rescue package, was signed into law by President Biden on March 11, 2021. Key takeaways. Weather data suggests that natural disasters are on the rise due to increased building in vulnerable areas and climate change. Businesses often suffer direct expenses, such as the cost of renovating damaged property and equipment, as well as indirect expenses from lost revenue. Researchers have found that the economic impact tends to be regional and fairly short-lived. Even larger storms have had a relatively small impact on gross domestic product, GDP. Natural disasters becoming more common. While dangerous weather events have always occurred, government data suggests that they've been happening more often over the past several years. According to the National Centers for Environmental Information, NCEU, 2020 was the sixth consecutive year in which 10 or more climate and weather events that cost $1 billion or more impacted the United States. From 2018 to 2020, there were 50 such events that, together, caused a total of $237.02 billion in damage. 1. From 2010 to 2019, there were 119 climate and weather events that cost $1 billion or more, causing an average of $80.02 billion in damage per year. The decade before that, 2009, saw only $59 billion events in the United States at an average cost of $52 billion. And the 1990s saw even fewer large weather crises, 52, which cost an average of $27 billion per year. 1. A number of factors are contributing to that uptick, according to the NCI, a division of the National Oceanic and Atmospheric Administration, NOAA. For one, Americans simply have more physical assets in vulnerable locations than in decades past. Much of the recent housing growth has occurred in coastal regions and river floodplains, which are at greater risk when hazardous weather events occur. 2. The NCE also suggests that global climate change is making these occurrences more common than in decades past. This shift can have a wide range of effects in the U.S., including drought and increased wildfires in the west and greater rainfall in the east. 2. Because Earth's average temperature has been ticking up at a fairly steady pace, the frequency of those climate-related events may only increase in the years ahead. According to the NC 2020 was the second warmest year overall. 3. 10 costliest disasters in the U.S. Since 1980, 1 Hurricane Katrina, 2005, $172.05 billion. 2 Hurricane Harvey, 2017, $133.08 billion. 3 Hurricane Maria, 2017, $96.03 billion. 4 Hurricane Sandy, 2012, $75.04 billion. 5 Hurricane Irma, 2017, $53.05 billion. 6 Hurricane Andrew, 1992, $51.03 billion. 7 U.S. Drought, Heat Wave, 1988, $45.04 billion. 8 Midwest Flooding, 1993, $38.06 billion. 9 Hurricane Ike, 2008, $37.05 billion. 10 U.S. Drought Heat Wave, 2012, $34.08 billion. All figures adjusted for inflation. Source: National Centers for Environmental Information. Who pays for natural disasters? Climate and weather-related calamities cause direct and indirect costs to the economy. The direct costs are perhaps more obvious, whether it's damage to commercial buildings and homes or the need to repair roads and power lines. But natural disasters also affect local communities in less obvious ways, through the disruption of businesses because of property damage or the inability of employees to report to work. 4. While a number of disasters are capable of creating extensive property damage and interruptions to commerce, the most expensive events in recent history have been hurricanes. Their combination of high winds and heavy rainfall can wreak havoc over a wide geographic area in a matter of days or even hours. The expenses for hurricanes and other events are usually picked up by a variety of public and private sources. Such was the case with Hurricane Harvey, which devastated Houston and its outlying areas in the summer of 2017. According to the Texas Comptroller's Office, the roughly $130 billion price tag for Harvey was met by the following sources. 4. Federal Emergency Management Agency, FEMA, provided payments to individuals, state and local governments, and beneficiaries of the National Flood Insurance Program. Small Business Administration provided home loans and business loans. U.S. Department of Housing and Urban Development, block grants. State and local funds, private insurance companies, non-profit organizations. The impact from the winter storms, power outages, and water shortages in Texas, Oklahoma, and Louisiana in February 2021 is estimated to have cost billions of dollars. The full cost is still being tallied. One estimate says that the damage in Texas alone in February is likely to surpass the more than $19 billion in insured losses for the state following Hurricane Harvey. 5. Impact of natural disasters on taxpayers. Just how big of an effect do these payouts have on federal taxpayers? According to a 2019 Congressional Budget Office, BO, estimate damage from hurricanes and other storms is expected to cost the U.S. government $17 billion a year. Roughly $11 billion of that is due to losses to the public sector. $4 billion covers aid that goes directly to individuals, and about $1 billion is allocated to administrative costs. The CBO projects that FEMA would have to increase the premiums for its federal flood insurance program to correct its projected shortfall. 6. However, individuals outside the damaged area may face certain additional costs beyond federal expenditures. In some cases, consumers have to pay more for certain commodities, including livestock and produce, that are lost due to weather events. In the wake of hurricanes Katrina and Rita, which decimated refineries in the Gulf of Mexico region within a month of each other, the price of gasoline spiked by roughly 30s, dramatically increasing transportation costs for both consumers and businesses. 7. 8. Natural disasters can also be devastating on an emotional level, as people lose cherished assets and sometimes even loved ones. Impact of natural disasters on the economy. Major storms can come at a heavy price for certain businesses, including stores and restaurants that depend entirely on a local customer base. However, research suggests that from a purely economic point of view, the effect of natural disasters tends to be regional, and businesses in the affected area typically recover quickly as they rebuild their property and replenish their inventories. According to Moody's Analytics, even a storm the size of Hurricane Harvey only created an $8.05 billion dent in economic output, a tiny fraction of the U.S. gross domestic product (GDP) of approximately $19 trillion in 2017. 9. Separately, a 2014 paper by economists at the University of Chicago and the University of Illinois found that the effects of Hurricane Katrina were relatively small in spite of the enormous damage inflicted on the Gulf Coast. Following the hurricane and its associated flooding, the researchers concluded that not only businesses, but also workers came out of it in good shape compared to those in similarly sized cities unaffected by Katrina. Income levels of those in the storm's path rose or even exceeded those of other urban areas within a few years, the researchers found. 10. The bottom line. History has shown that natural disasters are capable of exacting a heavy financial toll on governments, businesses, and private citizens. Because of climate change, the frequency with which storms and other weather-related events have occurred is picking up. And because Americans continue to build in vulnerable regions, the average cost of rebuilding is steadily increasing. Disaster loss. What is disaster loss? A disaster loss is a special type of tax. Deductible loss, similar to a casualty loss, where a loss has been incurred by taxpayers who reside in an area in the U.S. that has been designated as a federal disaster area by the President. Disaster losses can arise from such phenomena as floods, forest fires, and earthquakes. Key takeaways. Taxpayers who live in an area that has been designated as a qualified federal disaster area by the President and have suffered a loss are eligible to take the disaster loss deduction. 1. The types of disasters that have typically applied to disaster loss are natural disasters such as floods, hurricanes, tornadoes, fires, and earthquakes. Taxpayers can deduct losses related to the home, household items, and vehicles, but cannot deduct losses covered by insurance. 1. Understanding disaster loss. A federally declared disaster area is eligible for federal assistance once it is declared a disaster by the President. This is stated under the Robert E. Stafford Disaster Relief and Emergency Assistance Act, which was signed into law in 1988 and authorizes the federal government to provide various means of assistance to states and localities in the case of a declared disaster. 2. The Federal Emergency Management Agency, FEMA, keeps a list of declared disaster areas. 3. A qualified disaster loss is similar to a casualty loss, but may provide more favorable tax deductions. Not every federally declared disaster is known as a qualified declared disaster. Examples of declared disasters that were qualified include Hurricane Harvey, Hurricane Irma, and the California wildfires. Those qualified disasters had special tax relief options. 4. How to claim disaster loss. Typically, disaster losses may be deducted either in the year that the loss is incurred or the previous year, if it is more beneficial to the taxpayer and depending on the type of disaster. 5. A tax professional is best suited to distinguish which year is most beneficial for the taxpayer. Many people will take the deduction on the previous year because it provides them with an immediate refund on sudden losses. Homeowners who must relocate due to damage in a disaster area can often claim a loss even though the damage sustained does not meet the sudden event test. The sudden event test dictates that the loss must occur as a result of a sudden and unpredictable or unusual event. Disaster loss rules are the same for renters and commercial property owners as they are for homeowners. 6. FEMA provides a list of all eligible disaster areas and the years for which they qualify. 3. Disaster victims in these areas do not have to itemize deductions. They would report the loss on Form 4684 of the Standard Deduction Worksheet. Taxpayers who itemize report it on Schedule A. 7. How to calculate disaster loss. Taxpayers can deduct losses related to the home, household items, and vehicles, but cannot deduct losses covered by insurance. If the homeowner files an insurance claim right away, they can subtract the loss from the amount of reimbursement and deduct the remainder. The homeowner would take the adjusted basis of the property, or the decrease in the fair market value of the property because of the disaster, and subtract the insurance reimbursement. 8. 4. For example, if the adjusted basis of a property was $100,000 and the insurance reimbursement was $80,000, the tax deduction would be $20,000. What types of disasters apply to disaster loss? The types of disasters that have applied to disaster loss have typically been natural disasters including floods, hurricanes, tornadoes, fires, and earthquakes. As mentioned above, only taxpayers who live in an area in the U.S. that has been designated as a qualified federal disaster area by the President and have suffered a loss are eligible to take the disaster loss deduction. Safe deposit boxes. Store this, not that. What to store and not store in your. Safeguarding your valuables can be worrisome. There are many things you have to consider, including where you to put them and how much you want to pay for their safety. Sure, you can hide your valuables under your mattress with all that cash you've been stashing away. But that's probably not a great idea. You may consider buying a home safe or keep your valuables in a locked vault behind your uncle's portrait. Another option is a safe deposit box, which you can rent from a local financial institution. You may also hear them referred to as safety deposit boxes. Although you'll have to make a special trip to ensure your valuables are safe and retrieve them, you shouldn't keep everything in there. Read on for tips on what you should store in your safe deposit box and what you might need easy access to and should keep with you at home. Key takeaways. Safety deposit boxes are designed to withstand natural disasters such as fires, floods, hurricanes, and tornadoes. Never store the only copy of an important document in a safe deposit box. Safe deposit boxes are especially useful for people who aren't comfortable with digital storage. Although it's wise to have a co-lessor for your box, think carefully about assigning the best person. How safe deposit boxes work. A safe deposit box is an individually secured container, usually a metal box, housed in the vault of a federally insured bank or credit union. They're one of a number of services beyond banking your institution may offer. You can rent a safe deposit box to keep your valuables, important documents, and sentimental keepsakes secure. When you rent one, the bank gives you a key to use. You'll want to hold on to this key in a safe place because if you lose it, the bank will have to charge you to install a new lock. This key is used with a guard key held by the bank. If your bank uses a keyless system, though, you'll scan your finger or hand instead. Either way, you'll have to provide identification every time you visit the bank. You'll also have to sign in every time you want to access your box. You can rent a box in your name only, or you can add other people to the lease. If you opt for co-lessors, they will have equal access and rights to the contents of the box. So think carefully about whom you're thinking of adding. For example, people who have addiction, financial, marriage, or judgment issues may not be ideal candidates, even if they're family. Still, it's usually a good idea to name someone else to the account so they can access the box when and if you can't. Benefits of a safe deposit box. Security for a small cost. Safe deposit boxes are a great option for people for a number of reasons. For starters, they're undoubtedly more secure than most people's homes. So whatever valuables you own, whether that's gold coins, family jewelry, or stock certificates, banks are much harder to break into and located in secure areas with alarms, video cameras, and top-notch locks. The vaults that hold safety deposit boxes are also reinforced to withstand fire, floods, hurricanes, tornadoes, and other natural disasters. What does all this security cost? When you rent a safe deposit box, you can expect to pay anywhere from $40 to $300 each year and up. The price depends on several factors, including the size of the box you rent and the bank that holds your box. But remember, just because you have a box doesn't mean you should put all your valuables in it. Here are tips to help you decide what to keep in and keep out of a safe deposit box. What to store in a safe deposit box. Safe deposit boxes are a good place to keep hard. To replace documents such as contracts and business papers, military discharge papers, and physical stock and bond certificates, along with small collectibles and family heirlooms. Keep in mind that the largest safe deposit boxes are usually just 10 inches by 10 inches and 2 feet deep. This leaves plenty of room for irreplaceable photos and grandma's wedding ring, but not your antique doll collection. Good things to store in your safe deposit box are important items you won't need frequent access to, including 1. Personal papers such as original birth certificates, adoption papers, marriage licenses, and citizenship papers. Copies, but not the only copies, of wills and powers of attorney. Military records and discharge papers, EUG, Deed 214s, school transcripts, and diplomas. Sensitive documents you wouldn't want roommates, children, relatives, and visitors to find it. The deed to your house, along with any car titles. Paper stock and bond certificates, though most are issued electronically these days, including U.S. savings bonds. An inventory of your home's contents in case you need to file a claim with your homeowner's insurance policy. Important business papers, records, and contracts. Hard drives and flash drives with backups and important data. Financially or sentimentally valuable jewelry, collectibles, and family keepsakes. Other documents or small items that would be difficult or impossible to replace. Even though safe deposit boxes are designed to withstand natural disasters, it's a good idea to put anything that could be damaged by water into a waterproof container, such as a zippered plastic bag. This adds another layer of protection and can also help you keep your safe deposit box more organized. And before stashing those important papers and photos, make copies to store electronically on your computer or in the cloud. Just be sure your family knows how to access them. Items you shouldn't keep in a safety deposit box. You can access your safety deposit box during banking hours, which means you won't be able to get into it on holidays and, in some cases, on weekends. Store items you know you won't need in an emergency. Passports, medical directives, The only copies of wills and powers of attorney and other documents that you may suddenly need are better kept in a secure spot at home, such as a fireproof home safe that's bolted to the floor or wall. Safe deposit boxes can't be accessed 24/7, so don't put anything in them that you might need in a hurry. You're better off keeping the following items out of your safe deposit box. 1. Passports. Even if you're not a frequent international traveler, you never know when you'll need your passport for business, a spontaneous trip, or to help a relative or friend overseas. The only copies of important documents. The only copies of living wills, advanced medical directives, and durable powers of attorney are of little value if they are hidden away in a safe deposit box that no one can access. Tell your loved ones about the arrangements you've made and where they can find the documents. The only copies of your will. This is especially true if you haven't designated a co-signer to your safe deposit box. If you pass away or become incapacitated, it can be difficult for your loved ones to access your safe deposit box, and thus the only copy of your will. It's better to keep wills, living wills, medical directives, and powers of attorney in a secure place at home, such as that fireproof home safe, and tell a trusted relative or friend where they are and how to access them. Remember to give your medical proxy and the person who has your power of attorney copies of relevant documents. Valuables you haven't insured. Even though items in a safe deposit box are secure, you should make sure they're covered by your homeowner's insurance policy or a special rider, just in case. There are even companies that specialize in insuring safe deposit box contents. Keep in mind that the money you have on deposit in a federally insured bank or credit union is protected, but items in a safe deposit box are not. Tell your insurance company that the items will be kept in a safe deposit box. You might get away with a lower premium, as the items will be more secure than they would be in your home. 2. Cash. Again, the money you deposit in a federally insured bank or credit union is protected up to $250,000 per depositor per bank, but the cash in your safe deposit box is not. You're much better off keeping your money in a savings, money market, or other type of bank account where it will be insured. You may also be able to earn a little interest, something that won't happen if your cash is in a box. 2. Anything illegal. Firearms may or may not be permitted, so ask your bank for clarification if it's relevant. Explosives, hazardous materials, and illicit drugs are a no. No, needless to say. The bottom line. While safe deposit boxes have been offered by banks for about 150 years, with various other types of safekeeping offered long before that, fewer people today are renting safe deposit boxes, opting instead for digital storage and home safes. This can make it easier to find an available box, or more difficult if your bank no longer offers them. Betty Rios, a Bank of America spokeswoman, said demand for boxes has dropped significantly, especially among younger customers who are more likely to rely on digital storage, adding that fewer than half of its safe deposit boxes are rented. 3. Still, safe deposit boxes can be helpful, especially if you aren't comfortable with the digital storage environment. Some banks offer the boxes for free if you have a certain type of account or a certain balance with the bank. If you're interested in renting a box, start with your local bank or credit union. If it doesn't offer the service, ask a representative if they know who does, or look online to learn about the options in your area.